All right. Yo. So, I'm looking at option data in this episode. Um, I just want to show some things, and I think that we could actually find um some helpful indicators, honestly, that I don't think other people would really pay attention to when trading directionally or undirectionally. Really, if you want to condense price, it's actually very interesting. I think the data can be really telling. So let's just dive in quick and just see what it looks like. Now, I'll just zoom in one thing. Okay. So let's just start with GLD because I started with GLD, and this is the first time I'm running through this as well. So we'll see how it looks. All right. So generally, what I'm doing here is if you see these columns, I've got the strike price of the gold option, and I have a lot of expirations together. I've grouped a bunch of expirations. It doesn't matter which expiration. It just matters that we've grouped them all. We've got them all. We have all the data, and we're summing all of them together. So all the expirations at least. And we have a strike price on the left-hand side. We have the puts, we have the calls, and then that little put-call ratio. So let's take a look at the puts versus calls. Now, current price is in orange. That's where current price is. But let's pay attention to this. All prices above current price are in all puts are in the money, right? Yes. Yes. A 182 put has to be in the money. So therefore the arrow, let's say if the but it wouldn't work cuz all of them are calls. It's fine. But if you see this put call ratio of like, look, 58,000 puts but only 30 or 3,000 excuse me, 58,000 calls but only 3,000 puts. The put call ratio is huge in favor of the calls. Obviously, you can see that. But what does this mean? I don't know if we can put an arrow in here, but that's what it means to me. Arrow, insert. See that? All right, good. So, arrow, like I just see a big arrow. Have you ever seen um that like Mario Kart acceleration path? Look at this. Have you ever seen this? Where it's like you get on that path and it accelerates you? Like this. Each one of these highlighted regions accelerates the car. Shoo, shoo, shoo. It goes faster and faster, right? It's a little accelerator. Well, picture these little accelerators as these options, right? But look at if it's put heavy, it's going backwards, right? If price goes upwards, but that would mean the price goes downwards. So look at this. Now, take that idea in your take that idea. I'm taking that idea in my head and I'm looking at this and I see the arrow and I see 182, so many calls at 182. Look at this 180. So many calls at 180. There's a lot more puts there, but this one is just ridiculous. 0.1. Look. Yeah, and that's what I would call, oh, boom. That's a highlighted accelerate of price, because it's the calls point upwards, puts point downwards. prices above current price in the market, this is a snapshot, 95% of the options are calls. This is extremely weighted towards calls. That means pretty much all of these arrows are up. It's like it's up. It's very bullish. Now, if it were puts, then we'd think that, if these were all down arrows and it's red, what would that mean? It would mean if they were all red, let's say, and downwards, and all puts, mostly puts, that puts pressure downwards. So therefore, price is in the middle here at 178, right? Price is right here, and this is up and down. Just think of it as the chart. These are the numbers on the chart. If it's all down arrows here, it's condensing price downwards because the pressure is pushing downwards. And especially if there's calls up here, if there's up arrows right here, and these are bullish. Look at price, it's condensing price. I'm just going to drop a down arrow. That's fine with me. Oh. Wow. Oh, yeah, there you go. So now we're not even imagining it because we're already imagining too many things, right? So current price is at 178. If there's more puts, then there's way more puts here, way more calls here. It's condensing price, and you could say, hey, I'm going to bet on implied volatility staying small. I'm going to bet on a condor, an iron condor, condensing price, selling both sides, condensing price instead of a butterfly, which is the opposite way. A butterfly is this. In this scenario, it's a butterfly. It's a butterfly. So let's switch them around. In this scenario, it's certainly a butterfly. So this is the pressure, these are the pressures. If underneath current price, mostly puts are written than calls. It's 70-30. It's a lot more even than the 95-5, but there's no escaping the fact that there's more puts underneath current price than there are calls, So the puts, we already have an indicator of downwards pressure, right? Downwards. That means underneath current price is downwards. So if price were to go down, we're thinking that it will accelerate lower, and it's a butterfly effect. That means instead of price, here, take a look at this. Take a look at this. There's two different ways price can go. All right. Price can go like this. Condensing, and instead of breaking lows, it's really forming condensing price, and that's smaller volatility. And we're talking a daily chart, weekly chart, long term, right? It tries to test, a high, and it drops down. It not necessarily sideways. It could go up, but really, it's just smaller volatility. Now, imagine again here. Now, this is big it's becoming bigger volatility, right? It's becoming big. And that's what I'm saying here, that this calls for greater volatility because there's accelerates going upwards, there's accelerates going downwards if it goes down. So we're trying to trend the market. This is trend season, bro. It's trend season. It's like the turning of the seasons. Like we have a pulse on this, and we think that it's going to trend. It's more so trendy, like able to go up and up and up instead of just up, down, and more, instead of condensing price like a wedge, it's a ascending wedge. It's becoming greater. And that's what we're saying. So we're betting on volatility going up. That means butterflies instead of condors. And that's precisely what this is. It's calls above, buying calls above, buying puts below. That's a butterfly instead of a condor. We want a butterfly here. That's what I'm seeing. Now, this was taken at October 13th at 178. And let's just head to the charts quick and see what happened. This bar, oops. Oh, man. Right here is where this happened. This is 178. And remember 182s? Remember we were just talking about 182s? This was the strike price. All of this on the chart, if you see this, all above here are calls, man. They're calls. That's bullish. All below here are puts. Those are all puts, right? So if you look at it, price can either go different directions. So on a weekly chart, we are more so, let's see that this thing actually trends, right? And that's what happened here. It's been trending down. It's been trending upwards. It's not, look at this lower volatility. Now, if we see the option switch around where if it gets to a value where current price is way more, if it switches around, way more calls underneath and puts over the top, what this means is that the puts are pressing onto the calls and the arrows are arrows down, right? Down on the puts and then up on the calls, condensing price to be only in the middle here, only in the middle, right? That's what I see. That's what I would think. But right now, it has the opposite. It's the opposite effect right now. All the calls are above current price and all the puts are below. And that's what happens. So instead of coming into the calls and turning around, these guys are coming into the calls and accelerating more in this bullish. It's even more bullish now. You know what I'm saying? So that's my opinion. That's my opinion. We're going to jump into the triple Qs and see if they have the exact same effect. All right. Jumped into the triple Qs. And we see puts ahead of calls. Is that the opposite? It is the opposite of what happened in gold. And we'll get to see the future of what happens. So this will be really interesting because right now this is from October 9th data. October 9th. So there's been almost a month here that we get to see what happened. And I don't actually know. I'm not biased. I'm just looking at the data and seeing what happens here. So anyways, puts and calls. This has a different effect. Right now, I'm pulling these arrows to the calls above current price. Oh, no. Sorry. They're the same. Sorry, they're the same. Unfortunately, I started from the bottom. And now we here. I just sorted them wrong. Largest to smallest, sorry. Okay, so it doesn't have the same effect. All right, 366 right here. Perfect. All right, so You see this here? Oh man, messed that up. Some of the puts equals some of the calls, or not equals, but whatever. Just super quick here. Puts, good, calls. Okay. All right. So GLD was counting upwards, so it just looked like a price chart. Same thing with here now. Current price is at 366. Above current price is dominated by calls. Same thing in gold. So that's bullish. It's a bullish sign because we saw gold go up. We should see QQQ go up. And I think actually that's what happened. Anyways, and below current price is dominated by puts. It's the same deal. This is a volatility we want volatility. This is butterflies. Run the butterfly strategies instead of condors. Butterflies would work more because this is more of a trending market. It has green light for trending. It is this way because above current price is accelerating it upwards and saying, hey, you're up here, go further. And that's precisely what happens. Now underneath current price, the puts are saying go further. And it's accelerating price. If they were opposite, we would say it's going to be condensing and stop taking trend movements here, trend trades. This is a trending market for both GLD and QQQ. Now let's take a look at the chart of QQQ. Remember, 366 was current price, October 9th of 2023. So let's take a look. October 9th. What happened October 9th? October 9th is right there on that doji. Oh, this is a weekly chart. We need a daily. Just hold on here. October 9th right here. This is current price. Okay. Now remember, everything above it is bullish because it's oh man, it's more calls than puts. Now everything underneath it are way more puts than calls. So we want trend here. What happened was above price, current price, it went up, and we were thinking, hey, it's gonna accelerate upwards. Not quite. It turns around, comes back up a little bit, turns down, bounces up a little bit here, down. Okay. And then these puts launched it upwards. Wow. I'd like to see the data now. And see what it looks like now, to be honest with you, if it's changed or something. But that's currently what's happened. So it's kind of condensing price between these. But this is not condensing, right? This is current price. This is, it faked to go up and it trended down. This is a trend. These are long trends. Upwards, this is long trend. These are large moves. This is large moves. So on the 4 hour or something like that, or the 1 hour. Really? It's not very much. October 9th? It's not many trading days, I guess. Yeah, we don't see overnight on this thing, so anyways. So I guess, what are the takeaways? I don't know. I mean, I'm just thinking that it's more of a volatility goes up. That's all. Let's add average true range quick and see if volatility went up or down. So from this point, went down here, and then up up, 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 average true range as it trends downwards. That's a trend downwards. And then it came back up here with average true range dropping lower as it goes upwards. Average true range on the daily just increases, which makes sense. Maybe this is just a volatility gauge, you know, if puts are lined up below current price, and these are the arrows, you know. So I didn't take a look at specific high volume, like we should probably put single arrows on extremely high volume, important strike prices and stuff, and how that affects current price. If that affects the actual trading day, could. But in general, I'm just trying to understand the put call ratio, not as a whole. I think we should just put call ratio of above current price put call ratio versus below current price put call ratio. It's this way because keep in mind that a put, the puts option graph is this. You know, I don't actually know. It's like boom, doom, doom. You see that? And then the doom. See that? Like there's a limited risk. This is the risk, but then this is the reward. You could have huge reward. So puts and calls. Yes, there's a buyer and a seller between a put and a for each one of those. So like a put, there has a buyer and a seller, but really, the put is bearish. I think it is bearish. Even if you're writing them, you're selling short them to the selling the insurance, you know, you're selling the insurance. It's because there's unlimited profit for the buyer, and there's like a stop. They have a built-in, that's the max risk. As much as you paid for it, that's the maximum risk. You can't lose anymore. So therefore, puts have inherently, they're bearish. They're bearish, even if, yes, there's two people, there's a buyer and a seller to it, but it doesn't matter because the buyer has more power because the buyer has unlimited profit and limited risk versus the seller has unlimited risk and limited profit. So same thing with calls. Price goes up, you have unlimited potential. So calls are inherently bullish. They're very bullish. So that's where I take away from the put call ratio, but that's why I like to put it in terms of in the money or out of the money, because as you can see, it changes. Underneath the money, way more puts. Over the top, way more calls. So if you balance them all together and you get a big old fat put call ratio, it's really not giving all the information because it's averaging them out across these strike prices. But this current price is extremely important because these options are worthless. These calls are worthless. These calls are worthless. You know, if they can expire worthless. So if price goes up, there's going to be pressure to go up more because then now these calls are worth a lot. Now these calls are worth a lot and price goes up. Now these calls are worth quite a bit, you know, and now there's so there's a lot of interest in it going up, you know. So that's why I would say that that's an accelerator. Same thing as for puts too. But it is interesting that the market stacks up this way. Both in GLD and QQQ. It stacks up above current price. There's more calls written. Below current price, more puts written. That's just how it is. And I don't know if this is across the board, across all stocks. Like, I could do a vast study of like 8 just high volume stocks, uncorrelated. We could see if this literally happens with all stocks. I don't know. I just have only looked at gold and QQQ. But as far as I'm concerned, price did kind of the same thing. It goes down and then it went up. Same thing in GLD after it happened. It went. Oh, never mind. This was right here. It's only gone up for GLD. Both of them were bullish at some point, but I don't know. I don't think I can draw anything from that. But yeah, I thought that was interesting. So, peace.